Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you answers to all of your personal finance questions, and we speak about everything under the sun with regard to personal finance, whether it is your expenses or investments that you should make, and certainly insurance is something we speak about often, but we don't talk about motor insurance as much. It got me thinking, why do we not talk about it? And that's probably because it's not something you have a choice about. If you have a car or a scooter or a motorcycle, you're regulatorily required to have motor insurance. And for the longest time, this is not something you spent too much time thinking about. You probably got a few calls of people reminding you that your motor insurance policy is due to expire and offering you a certain premium or a certain product, and you would often choose the cheapest product. But is that the right way to look at it? There are quite a few changes that have come about in the recent past purely because of increased competition in the space, and you as a customer have more options available to you. And today I'd like to talk about motor insurance and what you should know about it to somebody who has created that disruption. I'm joined today by Varun Dua, who is the founder and chief executive officer of Acko Insurance. Varun, thanks so much as always for taking the time. Pleasure having you on the show.
Thank you, Alex. Good to be here.
Yeah, I do want to ask you about that because you cut out the distributor and you offer the product direct on your platform.
Yes.
And it's been a pretty big disruption in the industry from the perspective of the buyer as well. I'm curious, before we get into the building of motor insurance and how you should look at it as a product, what is the kind of behavior shift that you have witnessed as a company?
Interesting question. I think one of the things that we do see is that customers are getting more and more aware about what they want to buy relative to, like you rightly pointed out, it being some sort of a mandatory product which just gets bundled in with your car, or you get an phone call annually, and you just choose the cheapest one. Does that behavior exist? I think it exists, but by and large, we've seen a bunch of customers now starting to really discern, especially in India. Now you have a lot of second-time car buyers or second car buyers, right? A second car in the home or upgrading their car. These customers are fairly now clear about what insurance they want to choose, how they want to self-select into some options versus being chased down on the phone. And are quite adept at choosing their own coverage. There are still some misconceptions, which hopefully we can shed some light on together during this conversation. But yeah, we've seen a sea change from what it was 5-10 years ago. I think customers going directly and buying on platforms like ours is also a refreshing change, because frankly, a mandatory product should not have so much commission built in, and that's what we were trying to at least change from an Acko perspective.
Okay, interesting. We'll get into cost and we'll get into variance and what is offered in the product, but let's look at the product per se and try to define it. A lot of people look at it as this whole, but it's not that. It's actually a sum of the parts. So if you were to be asked by an average person like me, how should I look at motor insurance for a car or for a motorcycle that I own? Is there a base policy plus? How would you describe it?
Yeah, I think I think most people I've met don't understand the complexity of that. It's not one product. It's actually at the minimum two, and sometimes 2+ products that are bundled in when you talk about car insurance or bike insurance. The first distinction to make is that we've all heard the stories of a cop catching you and saying insurance ka paper kidhar hai. Now that insurance, what the government wants or the law of the land wants you to have, is called third-party insurance. Just for understanding, that third-party insurance is basically taking care of your risk in case your car ends up hitting someone else. It could be that person could have an injury, could lose a limb, or God forbid, worst case scenario, lose their life because you were driving. It could be an accident, you could lose control of the car, or you could hit someone else's property. That means that family or that person who's lost something because of your car needs compensation, and I may not have the money to pay that compensation. That's what third-party liability is. That means I'm liable to the third party. This part of the product where, because my driving or my car could injure somebody or cause destruction somewhere else, and that person needs to get compensated, is what is called third-party liability. This is the part that is mandatory. If you have only this product, the cops are okay, the government is okay, because they're saying whether if your car breaks down, or if your car has a broken bumper or a tail light or whatever it is, you can fix it using your own money. Whether you have insurance, you don't have insurance, is up to you. But if your car hit someone and they have to get hospitalized, you better pay up. And that's where the insurance part comes up. So mostly what people, all of us buy, is typically called comprehensive insurance, which has third party, which is the mandatory part. And the second bit, which is called own damage, which is damage to your own car. That's why it's called own damage. This is a third party damage, this is own damage. So when we buy it, we buy actually this bundle together, which takes care of the risk of hitting someone else or the damage to our vehicle itself. So those are the two pieces that typically get bundled together.
I don't want to ask you, sorry to cut you, and we'll build on this, Varun. Thanks so much for that breakdown, because so ultimately you're talking about two halves of this motor insurance product. One is mandatory, the other you can or cannot go for. Most people do go for it because ultimately that's one of the primary purposes of getting motor insurance. But actually, a lot of people don't know that regulatorily what they're required to have is the cover in case they do damage to somebody else or their property. So I'm glad that you've stipulated that. Now, if you are, as an insurance company and a seller of insurance, to explain from your perspective, let's not get into actuarial formulae or anything like that, but when it comes to the costing of this, what I pay as a premium, ultimately it's dependent on the risk involved. So how is it determined? Is it so the third party, I would think, is based on my behavior and based on certain other parameters, whereas the second thing, which is the own damage, would be partially dependent on my behavior and also on the vehicle involved, right?
Yeah. One slight, maybe correction, if I can use that word.
Yeah.
So today in India still, while it's fairly deregulated as a market, and there's a lot of openness in how you can design products from IRDA, the third-party liability portion of the premium that you pay, if you're paying A plus B, that third-party liability premium is not decided by the insurance company. It is decided by the government. So, and it is decided by the regulator and MORTH, which is Ministry of Road Transport. They jointly come up with the rates for third-party every year or every couple of years, and all insurance companies have to follow the same rate. And it depends on the class of vehicle that you are driving. So of course, a truck would be something else, a car would be something else, a 1000cc car or a 2000cc car, a sedan, SUV, everything has a separate rate. So there are segments for which, but the rates are stipulated by the government. So the insurance company is really not deciding the rates. They are actually just applying the rates that have been provided by the government and the ministry and the regulator. The own damage part is where you are free to price, or an insurance company is free to price the risk. And to give you a sense, you're absolutely right. Your driving behavior, to how many claims or accidents that you've had, to the class of vehicle that you own. For example, there are certain cars which parts are imported, right? So it may not be a very expensive car, but the parts are not locally manufactured. So getting those parts or replacing those parts is usually expensive. So your own driving behavior or record and the class of vehicle that you drive decides your own damage premium. So the own damage plus the government price that has been decided for third party, they come together and you pay a single price. That's how it works.
Got it. Okay. So, and then you have some other terminology here, which is things like zero dep, which is zero depreciation. There is, water damage. There is, certain other rodent-related damage. Yes. Are these all add-ons? How do they work?
Yeah, I think it's interesting as competition came up in India and globally also when it came up, people started differentiating a product which is a commodity product, right? Essentially, it's covering damage to your car. I'm no longer talking about the third party. I'm talking about just the damage to your car. Now, one of the things to understand is that and zero dep is probably the biggest one and the most critical one to understand. Is essentially when you buy a car and you buy insurance, every other car depreciates, which is forget insurance for a second. If you now try and sell a 3-year-old car, of course, you're not going to get the same value for the car that you got when you bought the car, right? The car is going to depreciate over 3 years, and the market value of that car could come down by half in 3 years. Now that means the market value of the bumper has also come down by half, which is, let's say if a brand new bumper was put in, which was costing 10,000 rupees, when the car costed 5 lakh rupees. Now, if the car is costing 2.5 lakh rupees, but it's because it's depreciated, the value of the bumper has also gone down from 10,000 rupees to 5,000 rupees. I don't know whether I was able to explain.
No, yeah, it's pretty
Yeah.
clear. It's pretty clear, yeah.
So when now it's a 3-year-old car, I end up banging that car and I have to replace my bumper. Of course, I'm not going to give you a 3-year-old bumper. I'm going to give you a brand new bumper. And when I give you a brand new bumper, that bumper cost me 10,000 rupees, but the value of the bumper as it stands today is 5,000. So 5,000, I'm keeping the math simple. So 5,000 will come out of the customer's pocket because you are getting indemnified for the value of that bumper, which is now 5,000, but I'm giving you a brand new bumper, which is 10,000. So 5,000, Mr. Customer, you have to pay from your pocket, which is the depreciation part of the payment that needs to be made. That bumper is depreciated by 50%, so that 50% is paid by the customer, 50% is paid by the insurance company. If you don't want to pay this, you have to buy this zero depreciation policy or the zero depreciation add-on, where you're saying, hey, charge me more, but I want the full cost of the bumper. Don't charge me the depreciation. If the customer doesn't want the depreciation to come out of his own pocket, they have to buy this add-on. So now when I put a 10,000 rupee bumper, the customer doesn't have to pay the 5,000 rupees I was speaking about because they bought this add-on. That's what it means. It's good, but it's not necessarily very good because these policies are expensive. So they work better for younger cars, newer cars. And if the car is 6-7 years old, it just sometimes doesn't make sense.
Oh, okay. So that makes sense because ultimately after that, the amount that you're paying is unnecessarily high. Is that fair? Yeah. So the cost of that zero dep add-on is more the older the car gets. Is that the right understanding?
Yeah, in some sense, it'll get very expensive, and a lot of companies, to avoid fraud, might not even offer it. Okay. To give you a sense, if my car is 6 years old or 7 years old, and now I want to sell my car in general outside of insurance, it creates a behavior of replacing most parts to make my car newer so that it can get better value.
Yeah.
So customers also sometimes, or bad actors, let me not call them customers, bad actors also try to game the system by trying to do some of these things. So typically after 5 years of the ownership of the car, this add-on is either very difficult to get or very expensive. So my general advice to customers is it makes sense in the first 3 to 5 years. After that, it doesn't make sense.
Yeah, insurance is not meant to make a product more valuable, ultimately. Yeah. And so therefore that is an easy metric to understand. You mentioned zero dep and zero depreciation, and you explained it pretty well. This is one major add-on. What are the other add-ons that are relevant in places like Mumbai? And here we're talking about a time when we've had an early onset of the rains. We're talking about possible flooding in certain areas. What do you need to know?
So one of the things that mostly a misnomer around is that insurance covers when there is an accident. Okay, an event needs to happen. That event could be, it's not just two cars colliding, a tree could fall on a branch could fall on your car, or any of those things could happen, but an event has occurred. So a flood is an event. If there is minor flooding and your car is submerged, typically it will cover your car, the repair to your car, but it does not cover your engine, because there has been no damage to that, no damage to the engine that has happened. There is something called engine protect. So for example, if your car is waterlogged, and you try to crank up the car, and the engine misfires. Typically, because of water damage, the engine can, misbehave or just completely become useless. Uh, this is not caused by an accident. Okay, this is caused by you cranking up the car with water inside it. Okay, especially very critical for now electric vehicles and ice cars and so on and so forth. In such a scenario, the engine damage, which is a very expensive part of the car, the engine itself, may not be covered. So let me give you an example. If I have an accident on the highway and somebody hits my car from the front and there's damage to the engine, it will be covered because it was part of an accident. But in this case, you just cranked up the engine. That's why it's very technical. Cranked up the engine. There was no event. The engine was waterlogged and you cranked it up. There was no event. The engine does not get covered. So because there was no accident, in per se. So the other one, in especially areas like Chennai and Mumbai, which see constant flooding, nowadays, frankly, even Bangalore, Engine Protect is something good to have, where it allows all sorts of damages to your engine to get covered. Beyond that, there are many. There is consumables cover, there is roadside assistance, there is return to invoice. There are many small add-ons. There are some keys also now which are very expensive. You have these wireless keys which sometimes could cost you 10,000-20,000 rupees just to replace the wireless key if you lose it. There are lots of small add-ons, but my general sense after being in the industry and watching consumers is probably between zero dep and zero dep and Engine Protect is where 80% of the uses are. The rest of it is relevant. If you want complete peace of mind, you should go for it. But these two probably are the most important ones.
Yeah, and also as you have an older car, as you pointed out, may not make sense to get even zero dep. But there's one more technical term that I want to discuss with you, and then we'll get into the claims aspect. The insured declared value.
Yeah.
Is that related to what we discussed in terms of the depreciation of the car?
Yeah, to a degree, it's so typically an insurance company would apply a depreciation chart to say that every year the value of your car comes down, and this number is relevant for two scenarios, specifically what we call total loss and theft. So now it's no longer about the repair of the car. You've totaled the car. Let's say it's beyond repair, or the car is stolen. So there is one finite value that needs to come to you, one fixed amount that needs to come to you. That is what we call the IDV of the car. Now that IDV of the car is really relevant only in these two scenarios, which is the total loss, which it is, it is called BER actually, technically, beyond economic repair. That is, there is no sense in now trying to repair that vehicle. It's total loss. And of course, if the car is stolen, that's when you get the IDV, which is the value of the car post depreciation. Now, because there's no perfect science to say what is the value of the car in the fourth year. Okay. It depends on variety of factors. To give you a case in point, Ford left the country a couple of years ago. The value of the cars would drop because, hey, will spare parts be available, not available? Just market value of the car may drop. So because there is no science, we operate in ranges. So the insurance company would give a broad range of what your value of the car could be. As a customer, you can, in that range, go for the higher value or go for the lower value. The only difference this makes is if you go for the higher value, the premium goes up. Correspondingly, the premium goes up a little bit. Your main benefit in choosing the higher value is that if your car is stolen or if your car is total, which is beyond repair, you get the bigger value.
Okay, understood. Now, you very nicely explained at the start the premium that a customer pays, and a portion of that, as you pointed out, third party is controlled by the government and government agencies. And so if that is revised upwards, ultimately everybody has to pay more. Does the other part of the insurance, which is own damage, get adjusted for inflation over a period of time? Does that keep going up?
Yeah. We've seen that it keeps going up by about, I'd say on an average, anywhere between 5 to 10% every year. And the reason it's regular inflation. So let's just simply to understand it. If the cost of the car part that needs to get replaced is going up, of course the value of the insurance will go up. If the labor charges, what mechanics charge in workshop to actually fix your car, as their wage bills keep going up, like any other job profile, that all that gets factored. Not like we sit and actually calculate how much of the wage bill is going up, but basically labor charges, part charges, bunch of these things. Typically, like any other part of the economy, these things will also go up, and therefore it gets priced in. Even on the third party side, which is the government decided rates, they also account for inflation and they increase the rates every couple of years. Right now, as we speak, last 4 years, there's been no increase. So we are due for an increase on the third party side. So premiums are likely to get expensive, slightly more expensive sooner or later. But probably the best way to understand it is that unless you've had many accidents and many claims, in which case your premium can shoot up, on a normal case, you will see a 5 to 10% inflation every year.
Okay, and you did mention a few instances where certain cars cost more. I think there is a perception, and you got to tell me if it's true, that certain vehicles that are also used as fleet cars in the transport space generally attract a higher premium, and these are well-known vehicles that are also used in the passenger space. Is that true?
Yeah, that's a very interesting one. See, one, whether a car is getting used commercially or privately, or a vehicle is getting used commercially or privately, is very clear because the number plates in India and the registration data is very clear what is being used commercially and what is being used. You have that yellow number plate, the registration says commercial use. So there's, let's say, a Toyota Etios, which we come across in Uber, Ola, sort of situations fairly often. So there are some of these cars which are registered for commercial use. That's not the problem because they're registered for commercial use and commercial rates apply. The problem starts to happen, or not problem, where customers can need to understand is there are some vehicles which are quasi-commercial, which we believe that take a Tata Sumo or a Qualis or some of these, Boleros, which we have seen in many parts of the country. They don't get registered as commercial vehicles, but they're being used commercially. It could be in villages, in tier 3 towns to transport people, and they're being used roughly like a taxi or a transport vehicle. And that's when this becomes like roughly a negative profile for the insurance industry, that we don't believe this car is being used privately, even though it may be registered as a private vehicle. And sometimes the rates for these kind of cars or these kind of vehicles tends to go up because they don't believe, the insurance industry doesn't believe that this car is being used for private purposes.
Got it. Okay. All right. The last aspect has to do with claims. And as a relatively new company, I'm sure that you had to deal with quite a few issues here. And generally the perception, and this is anecdotal evidence, that you've actually attempted to do as much as you can to ensure a seamless process. You're completely digital. What do you need to know from the perspective of a customer making a claim so that this entire process is seamless?
See, customers don't have to do much actually. All the customers have to do is report that incident. They could, like for a company like Acko, they could just come onto the app or the website and just tell us what happened. In case they're in a difficult situation, let's say the car is stuck on the road, they could just pick up the phone and talk to us, and somebody will come pick up the car, take it to the workshop, repair it, get it back, and everything. For them, they just have to keep approving stuff and on the app. So all that they need to do is either speak to someone and use the app and say this is what has happened, and somebody just takes over from there. I think one thing customers should be careful about in general, whether they deal with Acko or with any other insurance company, is have a clear view and not let the workshop or the dealership or wherever they want to take their car decide what will go in claim, what will not go in claim. One of the things that we've noticed is that customers tend to doubt themselves and try to trust the workshop to handle the claim for them. And it is in the interest of the workshop to increase the billing as much as possible. because whatever repair money will go to the workshop is revenue for them, and that hits the insurance rates of the customer in subsequent years, right? Is to just be aware that they should not hand over the entire process to the workshop and work in parallel with their insurance company. I think not only Acko, most insurance companies in India, I would say, are fairly fair. They are deeply regulated. So it's not that much of a trouble to deal with an insurance company. I think it's a perception. It's when you want to use a middleman, usually, is when you don't realize that their incentives might be different than your incentives.
Okay. A quick last view, just to give us some color and perspective. Again, you don't need to answer this. I'm just asking you out of curiosity. What is the kind of traction that you've seen, particularly at the first leg, in that when you're at the showroom? Because I think that's something that a lot of people have realized when they're buying new vehicles. They don't necessarily have to buy it as a bundled product.
Yeah, that's the most, I'm going to say something semi-controversial, if I can say that. The customers in India have lost thousands of crores of rupees over the last 5 years, collectively, of course, not one customer, in buying insurance which is 2 to 3 times of what they should be getting charged for insurance, because that's the amount of commission that gets bundled in a new car. To give you a sense, you don't even negotiate your insurance premium when you're buying a new car. You're essentially talking to the car dealer for on-road price, right? Finally, on-road mein kitna discount milega, or you're just trying to negotiate what will you're negotiating a package versus negotiating accessories or insurance separately. And what customers don't realize is that there's a huge amount of commission built in. I'll give you a number as we speak right now. It may not be surprising to take a car like Tata Nexon today, which is, let's say, a popular car, and go to a car dealership and take any popular car. Let me not get into specific names. Take any popular car and you'll figure out that the premium could be anywhere between 75,000 to 1 lakh rupees at the dealer. The actual cost of it, or where Acko would be selling that, probably be 40,000 bucks. So what we've seen is customers now starting to understand that they don't need to pay so much for insurance. There's a lot of bundling in and a lot of commission that gets set in while buying the new car. And the first leg, like you pointed out, it's been very exciting for us to see. I mentioned right at the beginning of this conversation that most second-time car buyers could be upgrading their old car or buying a new car in the household, are starting to look at insurance differently. And when we look at our Acko data, most people who are decoupling the purchase of the insurance from the dealer when they're buying a brand new car are smarter, financially savvy, more astute customers, and realize that they can decouple this financial product from the car.
Fair point. All right, Varun, on that note, thanks so much for taking the time for speaking to me on NDTV Profit. And that brings us to the end of this edition of Your Money Matters. You know now more than you did before about motor insurance. Thanks so much for watching. This is NDTV Profit.